I would like to, to say we are honored to receive Your Excellency here, delivering a speech about, the update on the financial markets. Your Excellency and your team most welcomes in, United Arab Emirates, in Dubai, and in the Security and Community Authority branch here in Dubai. By the way, our head office is in Abu Dhabi. But, our branch opened, in 2013. It contains all the supportive departments, including the training center and licensing departments here. So I would like to introduce you here to the colleague member here, Mr. Daniel Gulliver. He is the Commissioner of the Security and Exchange Commissions. He is involving in the Division of Enforcements, Division of Trading and Markets, represent commissions in Lehman Brothers liquidations, in central clearing of swaps and matter involved of SIPC. He will explain what that means because it doesn't mention here. He is chairman of committee number 6 in IASCO Technical Committee. Also, he is holding a law degree, I think master degree in law, from the Catholic University of America, and bachelor degree in English from Georgetown University. So, most welcome, Your Excellency. Please, the floor is yours. Thank you very much.
Well, thank you very much for having me here today. It's an honor for me to come and visit with you again. It's my second visit to Dubai in my tenure as a commissioner, and I should explain real fast because otherwise sometimes it gets confusing if you don't know the composition of the Securities and Exchange Commission. There are 5 commissioners. We're all appointed by the President and confirmed by our Senate. No more than 3 of us can be from the same political party as the President. So I'm actually one of the minority members of the commission, and I feel I have to tell you this because sometimes it gets very confusing for people when they say, how could Obama get it so wrong to pick this guy? He disagrees with everything Obama does. So, but I do. So we each have a 5-year term. Every June, one of our terms expires. I'm in my 4th year, so June of next year, my term will expire. And so in my 4 years, I've been focusing in many ways on issues, international issues, on part of my own agenda, not necessarily the formal agenda of the SEC. The formal agenda of the SEC is set by the chairman. The chairman right now is Mary Jo White. I don't know if you've encountered her at all in any of the formal settings. She's been the chairman for 2 years. But as a commissioner, we each get to set our own personal agendas too. And one of the things that's been very important to me as coming back as a commissioner, I used to be, as was mentioned, on the staff of the SEC during the financial crisis and before, but coming back after the financial crisis, it's been very important for me to focus on what's happening in other markets. And by other, I mean non-US EU markets. So much of the international dialogue in America is focused on the European Union and the constituent members of the EU, and that there's a long history of that. I find it somewhat ironic in the post-financial crisis environment that we focus on that dialogue so much, considering that the economies, both in the US and the EU, aren't doing so well, that the causes of the financial crisis stemmed out of those jurisdictions and not places like the Middle East, not Asia, not South America. And so much of the work that's happening of the agency right now at the supranational level, whether it's IASCO or the Financial Stability Board, is responsive to the financial crisis and is work being done and expected to be implemented around the world, right? So whether it be an FSB pronouncement and an IASCO pronouncement, there'll be an expectation even here in the UAE that you might implement these international standards. And if they're good standards and they make sense for your markets, that's terrific. But if they don't, I find it very interesting that there's an expectation that you would take them up. And so Since I've come back, I've tried as much as possible to stay away from the US-EU dialogue. Not that it isn't important, but I've made it a point of priority to come to, I don't even like to say emerging markets because so many of them are fully emerged, like here in Dubai, like in Asia, but to focus on the non-traditional market centers and to see what's happening in these markets. In particular, what's happening with international financial centers, and that's why I'm completely fascinated with your IFC here. I find it to be an amazing experiment. It's a laboratory of so many things that are different than what we're doing in the United States and what we're doing in Europe. I hope and expect that it will be successful as you plan, and I'm interested after these meetings to go and talk to the DIFC folks and hear how things are going. But at a time where in the United States, before the financial crisis, we were being very introspective. We were thinking about whether our markets were competitive still, whether there were too many barriers in our capital markets to entry for new participants, why public companies listings were going down, why we were losing market share to Europe. There were a number of bipartisan reports and studies done in the years leading up into 2008 that laid out a number of problems in our own capital markets. Then, of course, we have the financial crisis. Those studies are all pushed to the side. And what we got out of the United States Congress, a majority of the Congress, not the full Congress, was the Dodd-Frank legislation. And Dodd-Frank was the response by Congress to the financial crisis. And so in the United States, and I'm sure there'll be some similarities here, most of the legislation that comes out dealing with the securities markets is in response to a crisis. So in 1929, we had the Great Depression, the stock market crash. We had all of the legislation that created federal securities laws within 5 years after that, the major pieces of legislation. We had in early 2000s, after the accounting scandals at WorldCom and Enron, we had Sarbanes-Oxley. And then, of course, after the 2008 financial crisis, we had Dodd-Frank. Now, Dodd-Frank can be distinguished in a number of ways. The two most important are that it's absolutely massive in size. The legislation itself is 2,319 pages. So if you put it on your table, it's this big. So it's just huge in size. It's mostly a series of mandates to the financial services regulators. Go off and do this rulemaking. So even though it's so long, it's not comprehensive in the sense that it explains exactly what to do. It defers to the regulators. So there are about 400 mandates to regulators. I'm going to use round numbers in Dodd-Frank. The SEC got 100 of the 400, so we actually got the most of any regulator. And they covered a wide range of topics. Most of them, or a lot of them, surprisingly having nothing to do with the financial crisis at all. And I'll explain that. That's the other feature of Dodd-Frank that distinguishes it from earlier legislation. Dodd-Frank was passed in the US Congress by a slim, bare majority vote. It was not bipartisan at all. There were, in both chambers, in our Senate and in our House, total, there were 6 votes by the minority parties. So it was pushed through on a majority basis. So it didn't have that back and forth negotiation. It wasn't tempered by the back and forth. And that distinguishes it. Even Sarbanes-Oxley, which was very burdensome and which a lot of people didn't like because they thought it burdened our capital markets, was a huge bipartisan piece of legislation. And the same with the original securities laws in the 1930s. And that 2 months after Dodd-Frank was enacted, the majority turned over in our House of Representatives. The Republicans took control of the House. So in January of 2011, when the Republicans came into power, not one of them, I believe, had voted for Dodd-Frank. They were in stark opposition to it. And so much of the work of Dodd-Frank had yet to be completed because the regulators were the ones that were set to implement it pursuant to these mandates. And so Dodd-Frank has become a very contentious piece of legislation. And of course, just this last year, the Senate changed control too. So you have an entire Congress who's opposed to this legislation, and you have a regulatory body, whether it be us, the Federal Reserve Bank, the Comptroller of the Currency, the FDIC, all steadily working still on the mandates of Dodd-Frank. So financial services regulation is a very heated discussion right now. There's a lot of back and forth about whether the rules that we're promulgating pursuant to Dodd-Frank actually address the financial crisis, whether they will help us stave off the next financial crisis, and of course, what we expect other jurisdictions to do by way of these regulations. Because Dodd-Frank came out all at one time, and I'm sure you've noticed in the EU, they're following largely what was done in Dodd-Frank, but they're doing it one directive at a time. And whether derivatives is probably the best example, the OTC derivatives rulemakings, where Title VII of Dodd-Frank, so one chapter of Dodd-Frank deals exclusively with that. You have an EU directive that does effectively the same. So the US and the EU are engaged in this process of legislating and implementing. The FSB is taking a role, and I think the international community, many members of the international community, are rightfully suspicious of some of the requirements, whether it fits their home markets. I would tell you in Asia in particular, I think there's a lot of skepticism about whether they should adopt these issues. And so within this sort of heated point in time with financial services regulation, I have found it very useful to come out and talk to other markets and learn their perspectives, what may or may not work in their home markets, how alternatives to the things that we're considering in Dodd-Frank and elsewhere might make more sense, how the markets have evolved, to provide market practices that might do a better job than federal regulation. And so it's great to be back here, where again the IFC and the very idea of creating this free market center is so at odds with what we're doing back in the States, where again we had all this work to say our markets need to be repaired, then a financial crisis, now all this regulation. So we had those existing issues, and now we're burdening the markets more and more with these regulations. Where we're doing that, you're trying to get the DIFC up and running. Where last in 2013, when I was here last, I left Dubai and I went to Istanbul, and I was amazed to sit in this ancient city, and they just passed new legislation mandating that Istanbul will be a top 20 world international financial center by 2020. And whether that happens or not, whether it's possible politically, culturally there, I don't care. I just find it fascinating that that's what they're thinking about. Later in that year, I went to Moscow. Moscow was doing the same thing. Of all places, Moscow being an international financial center, who knows if it can happen there, but they're committing resource to these types of analyses. Singapore, Hong Kong, I was in Shanghai last year. This discussion of international financial center, reducing barriers to trade and commerce is happening all around the US and the EU, and I find that absolutely fascinating. And it's helped me tremendously as a policymaker to come back to the United States, learn these perspectives, and say, maybe this doesn't make much sense, where certain provisions of Dodd-Frank are intended on their face to apply across the world, right? To apply here in Dubai, maybe that might not make sense as a matter of comity, relationship with other jurisdictions, but also maybe it doesn't make sense given the nature of the markets. Maybe there's no need. And so traditionally, folks have done in the global international regulatory community have simply followed what the US and the EU have done, the so-called gold standard of regulation. And I think we've reached a point in time where maybe that's not necessarily going to be the case. I think it's a critically important time to be looking at these types of issues, because I mentioned that the SEC had 100 rulemakings that were mandated under Dodd-Frank. We're not even halfway done, these rulemakings. So in July of this year, the Dodd-Frank Act will be 5 years old. The financial crisis will be 7, 8 years old, depending on when you say it started. And we'll not yet be halfway done the rulemakings under Dodd-Frank that were meant to address the financial crisis. So there's serious questions about the nature, the number, the quantity and the sort of political aspects of Dodd-Frank happening back in the U.S. And so, again, this is for me tremendously valuable to hear your perspectives, and I'll try not to talk too much so we can have a back and forth of Q&A. One thing that has happened positively in the U.S. and that I'd like to share with you is in 2012, because it was a presidential election year, we actually had a piece of legislation called the Jobs Act. And the Jobs Act was the first piece I've seen ever of really deregulatory securities regulation. And it happened, we call it the perfect political storm in Washington. It was a presidential election year. You had the House of Representatives controlled by Republicans. It was looking like basically a public offering. The problem is in the United States, and it's unique to the states, is that these offerings were not exempt from state law. So some federal securities law, most federal securities law, preempts state law. It takes precedence over the state law. Some things don't. And there's a tension between the states and the federal government on that issue. And Regulation A offerings were not exempt traditionally. So folks would say, why would I use this? Because now I have to register in every state where an investor might be. In this day and age of the internet, where you can reach everyone across the United States, much less internationally, why would I put myself through that when I can use other exempt offering provisions instead that don't have this requirement and that preempt state law? Regulation D in particular is the number one exemption that's used in the United States. That's the one I was talking about earlier. In the context of general solicitation, it's Regulation D, which is unlimited in amount. You can raise whatever you like. You have to sell to accredited investors, and it preempts state law. So that has become a $1 trillion a year market for us. Regulation A in Title IV, though, the Congress said, take the limit from $5 million and make it 50. And mandate only very limited disclosure, so a scaled back form of disclosure from what we normally require from public companies. And they strongly suggested that the SEC, when we conduct the rulemaking, preempt state law, which we had the power to do. So we just finished that rulemaking a month ago. The rule will go into effect in 30 days. And what we're going to have is a new exemption that's quasi-public, because you can sell it to anyone, where we have semi-annual, not quarterly reporting, which is really very different from our public reporting regime today. There's a lot of talk about short-termism and CEOs managing companies quarter to quarter and those pressures. Well, this is going to be a fascinating experiment because you're going to have the semi-annual reporting. There's a very scaled back sort of ad hoc reporting regime. Right now we have what we call 8Ks for public companies. So if you have some material event, you issue your 8K. There's a light touch version of that in Reg A, but much less onerous. And the one thing we don't have, and I'll close on this one point because I know you guys are interested in SME trading issues, secondary market trading issues. What we will not have, though, for Regulation A is a trading market. So Congress focused on the offering side, so now you can offer these securities, but where are you going to trade them? They will not be eligible because of the listing requirements of the NASDAQ and the New York Stock Exchange for trading on either of those exchanges. So once they're offered, the secondary market for these securities will be inherently over-the-counter, which are relatively decently developed markets in the United States, but still very opaque. These are markets where investors find more fraud than other markets. The reporting requirements aren't the same. The brokers making markets in these markets tend to have very wide spreads, so they can capture a lot of the money. So it's very expensive for investors. And so one of the things that we're focusing on right now at the SEC, and Congress is focusing intently on, are what we call venture exchanges. So a new tier of existing exchanges or brand new exchanges that cater to small and medium-sized companies. Because as much work as the Jobs Act has done to facilitate IPOs, we still see a major gap in IPOs, real operating companies, not this one niche in biotech that I talked about before, between $0 and $250 million in market cap of companies that just don't want to go public anymore. And in large part, it's because there is no secondary market. You can't go to the NASDAQ, you can't go to the New York Stock Exchange. And so we're thinking about having a tier or having an exchange catered to those companies. And we might, and this is the best part about the Reg A regime, you would have a tailored disclosure regime that fits these companies at that stage in their development. You don't have quarterly reporting, you have semi-annual, right? You tailor some of these things to make it easier for them in their evolution to reaching the top tier of the market. We don't have a regulatory scheme established yet that allows the exchanges to offer that service or allows issuers to avail themselves of it. Right now it's either you're going to stay private and you're going to sell yourself to Facebook instead of going public, or you're going to go wait until you can go public at the very lowest level at the NASDAQ, which has the small cap market, which the standards are still relatively high. And so there's a real push at the Commission, but also in Congress, to set up this regulatory regime to create this market. And this is, for me, I've been driving this for a couple of years now, trying to push to facilitate this market. It's been one of the real benefits of having visited a number of other jurisdictions, South Korea, the UK, of course, you know, the AIM market, which I think, quite frankly, would be a lot smaller. The AIM market in some ways is like the crowdfunding market that I told you about earlier. You know, the offerings are generally £2 million or below, so we're talking about a much bigger market there. But we see in Canada, too, the Toronto Stock Exchange has a venture tier where a significant portion of the companies actually graduate to the main exchange after a while. That should be the focus, incubating these companies in a public way, allowing the public to participate in it, not just limiting the activity to accredited investors, to millionaires. But we have yet to set that up, and hopefully we can do so. Given the burdens of everything else we're doing with the 50 or so remaining Dodd-Frank rules, with all the international standards and everything else going on, we're trying to do something proactive here, building off the success of the Jobs Act. And I understand that that's of interest to you here too, how to facilitate the SMEs. I just came from Mumbai, and the Indian regulator, SEBI, has actually recently created a similar regime. I think it's 250 million rupees and below, so that you can, and they limit participation to, it's not to everyone, there's small lot sizes, so you'll basically have more affluent people or small institutions participating. But I think this idea is taking on more and more importance around the globe, and it'll be interesting to see. And one last little point, as we do this on the equity side, one other work stream that we're thinking about is the fixed income markets, whether they be the municipal markets. We have a very interesting tax-exempt municipal market, which is idiosyncratic to the United States, but more importantly, the corporate debt markets, which I know are important here. I know the Qataris are very interested. We were talking to the Indians, and of course in the EU, folks are more and more focusing on corporate debt markets, how to facilitate the growth of these markets, especially as the new Basel standards come into place in jurisdictions that are dependent on bank lending, where the banks won't be able to lend so much to businesses anymore because of Basel. How do you develop the corporate debt markets? We have about $11 trillion outstanding in our corporate debt markets, and we've had $1 trillion a year issued for the last 5 years because of the interest rate environment in the United States. It's very cheap financing for U.S. companies. And so as that's happening, we're actually, we have a very vibrant corporate debt market, but the market structure is very opaque, very over-the-counter. It's very different than the equity side. So we're wrestling with the market structure for fixed income. How do we make it more transparent? How do we assure that there will be liquidity? Because with all the limitations on what the banks and the dealers can do in these markets, we need to ensure that there'll be liquidity there. And so with all that as background, I'd be happy to talk about any of these issues or anything else that might be on your mind.
Thank you very much.